46 Accountancy. Learning Objectives. After studying this chapter, you will be able to describe the nature of transaction and source documents. Explain the preparation of accounting vouchers. Apply accounting equation to explain the effect of transactions. Record transactions using rules of debit and credit. Explain the concept of book of original entry and recording of transactions in journal. Journal. Explain the concept of ledger and posting of journal entries to the ledger accounts. Accounts. In Chapter 1 and 2, while explaining the development and importance of accounting as a source of disseminating the financial information along with the discussion on basic accounting concepts that guide the recording of business transactions, it has been indicated that accounting involves a process of identifying and analyzing the business transactions, recording them, classifying and summarizing their effects, and finally communicating it to the interested users of accounting information. Information. In this chapter, we will discuss the details of each step involved in the accounting process. The first step involves identifying the transactions to be recorded and preparing the source documents, which are in turn recorded in the basic book of original entry called journal and are then posted to individual accounts in the principal book called ledger. 3.1 Business transactions and source document. After securing good percentage in your previous examination, as promised, your father wishes to buy you a computer. You go to the market along with your father to buy a computer. The dealer gives a cash memo along with the computer, and in exchange your father makes cash payment of $35,000. Purchase of computer for cash is an example of a transaction, which involves reciprocal exchange of two things, I. Payment of cash, E. Delivery of a computer. Hence, the transaction. Recording of transactions I3. Rationalized 2023-24 recording of transactions, I47. Involves this aspect, i.e. give and take. Payment of cash involves give aspect and delivery of computer is a take aspect. Thus, business transactions are exchanges of economic consideration between parties and have twofold effects that are recorded in at least two accounts. Business transactions are usually evidenced by an appropriate documents such as cash memo, invoice, sales bill, pay-in slip, check, salary slip, etc. A document which provides evidence of the transactions is called the source document or a voucher. At times, there may be no documentary for certain items, as in case of petty expenses. In such case, voucher may be prepared showing the necessary details and got approved by appropriate authority within the firm. All such documents, vouchers, are arranged in chronological order and are serially numbered and kept in a separate file. All recording in books of account is done on the basis of vouchers. Transaction voucher. Name of firm. Voucher no, date, debit account, credit account, amount, backquote, narration. Authorized by, prepared by. Fig. 3.1, showing specimen transaction voucher. 3.1.1 Preparation of accounting vouchers. Accounting vouchers may be classified as cash vouchers, debit vouchers, credit vouchers, journal vouchers, etc. There is no set format of accounting vouchers. A specimen of a simple transaction voucher is used in practice as shown in Figure 3.1. These must be preserved in any case till the audit of the accounts and tax assessments for the relevant period are completed. Nowadays, accounting is computerized and the necessary accounting vouchers showing the code number and name of the accounts to be debited and credited are prepared for the purpose of necessary recording of transactions. A transaction with one debit and one credit is a simple transaction, and the accounting vouchers prepared for such transaction is known as transaction voucher. The format of Rationalized 2023-24 Accountancy, which is shown in Figure 3.1. Voucher, which records a transaction that entails multiple debits, credits and one credit, debit, is called compound voucher. Compound voucher may be a. Debit voucher 07R, b. Credit voucher. The specimen is shown in figure 3.2. Debit voucher: name of firm. Voucher: no, date, credit account, amount. Debit accounts. S. No. Code: account name, amount, narration, i.e. explanation. Authorized by, prepared by. Credit voucher: name of firm. Voucher: no, date, debit account, amount. Credit accounts. S. No. Code: account name, amount, narration, i.e. explanation. Authorized by, prepared by. Fig. 3.2, showing debit and credit vouchers. Rationalized 2023-24 recording of transactions, I-49. Transactions with multiple debits and multiple credits are called complex transactions, and the accounting voucher prepared for such transaction is known as complex voucher, journal voucher. The format of a complex transaction voucher is shown in figure 3.3. Journal voucher. Name of firm. Voucher: no, date. Debit accounts. S. No. Code: account name, amount, narration, i.e. explanation. Credit accounts. S. No. Code: account name, amount, narration, i.e. explanation. Authorized by, prepared by. Fig. 3.3, showing specimen of complex transaction voucher. The design of the accounting vouchers depends upon the nature, requirement and convenience of the business. There is no set format of an accounting voucher. To distinguish various vouchers, different color papers and different fonts of printing are used. Some of the specimen of the accounting vouchers are given in the earlier pages. An accounting voucher must contain the following essential elements. It is written on a good quality paper. Name of the firm must be printed on the top. Date of transaction is filled up against the date and not the date of recording of transaction as to be mentioned. The number of the voucher is to be in a serial order. Name of the account to be debited or credited is mentioned. Rationalized 2023-24 50 accountancy. Debit and credit amount is to be written in figures against the amount. Description of the transaction is to be given account-wise. The person who prepares the voucher must mention his name along with signature. And the name and signature of the authorized person are mentioned on the voucher. 3.2 Accounting equation. Accounting equation signifies that the assets of a business are always equal to the total of its liabilities and capital, owner's equity. The equation reads as follows: A equals L plus C, where A equals assets, L equals liabilities, C equals capital. The above equation can also be presented in the following forms as its derivatives to enable the determination of missing figures of capital, C, or liabilities, L. I, A, L equals C, E, A, C equals L. Since the accounting equation depicts the fundamental relationship among the components of the balance sheet, it is also called the balance sheet equation. As the name suggests, the balance sheet is a statement of assets, liabilities and capital. At any point of time, resources of the business entity must be equal to the claims of those who have financed these resources. The proprietors and outsiders provide the resources of the business. The claim of the proprietors is called capital and that of the outsides is known as liabilities. Each element of the equation is the part of balance sheet, which states the financial position of the business on a particular date. When we analyze the transactions, we actually try to know that how balance sheet of a business entity gets affected. Asset side of the balance sheet is the list of assets, which the business entity owns. The liabilities side of the balance sheet is the list of owners' claims and outsiders' claims, i.e., what the business entity owes. The equality of the assets side and the liabilities side of the balance sheet is an undeniable fact and thus justifies the name of accounting equation as balance sheet equation also. Rationalized 2023-24 recording of transactions, I-51. For example, Rohit started business with a capital of $500,000. From the accounting point of view, the resources of this business entity is in the form of cash, i.e., $500,000. Sources of this business entity is the contribution by Rohit, proprietor, $500,000 as capital. For the purpose of understanding, we will refer this example as example 1 throughout the chapter. If we put this information in the form of equality of resources and sources, the picture would emerge somewhat as follows. Books of Rohit balance sheet as at liabilities amount, assets amount. Capital 500,000, cash in hand 500,000. 500,000, 500,000. In the above balance sheet, the total assets are equal to the liabilities of the business. Since the business has not yet started its activities and has not earned any profits, the amount invested in business is still $500,000. In case any profits are earned, it will increase the invested amount in business. On the other hand, if business suffers any losses, it will decrease the invested amount in business. We will now analyze the transactions listed in example 1 and its effect on different elements, and you will observe that the accounting equation always remain balanced. Example 1. 1. Opened a bank account in State Bank of India with an amount of $480,000. Analysis of transaction. This transaction increases the cash at bank, assets, and decreases cash, asset, by $480,000. 2. Bought furniture for $60,000 and check was issued on the same day. Analysis of transaction. This transaction increases furniture, assets, and decreases bank, assets, by $60,000. 3. Bought plant and machinery for the business for $125,000 and an advance of $10,000 in cash is paid to M.S. Ramji Lal. Analysis of transaction. This transaction increases plant and machinery, assets, by $125,000, decreases cash by $10,000 and increases liabilities, M.S. Ramji Lal as creditor, by $115,000. Rationalized 2023-24 52 accountancy. 4. Goods purchased from M.S. Sumit Traders for $55,000. Analysis of transaction. This transaction increases goods, assets, and increases liabilities, M.S. Sumit Traders as creditors, by $55,000. 5. Goods costing $25,000 sold to Rajani Enterprises for $35,000. Analysis of transaction. This transaction decreases stock of goods, assets, by $25,000 and increases assets, Rajani Enterprises as debtors $35,000, and capital, with the profit of $10,000. The final equation as per the above analysis table can be summarized in the form of a balance sheet as under. Balance sheet as at 2017. Liabilities amount, assets amount. Outsiders claims, creditors, $170,000 cash, $10,000 capital, $510,000 bank, $420,000. Debtors $35,000 stock, $30,000 furniture, $60,000 plant and machinery, $125,000. $680,000, $680,000. In terms of accounting equation, A equals L plus C $680,000 equals $170,000 plus $510,000. 3.3 Using debit and credit as already stated, every transaction involves give and take aspect. In double entry accounting, every transaction affects and is recorded in at least two accounts. When recording each transaction, the total amount debited must equal to the total amount credited. In accounting, the terms debit and credit indicate whether the transactions are to be recorded on the left-hand side or right-hand side of the account. In its simplest form, an account looks like the letter T. Because of its shape, this simple form called a T account, refer figure 3.4. Notice that the T format has a left side and a right side for recording increases and decreases in the item. This helps in ascertaining the ultimate position of each item at the end of an accounting period. For example, if it is an account of a customer, all goods sold shall appear on the left, debit, side of customer's account and all payments received on the right side. The difference between the totals of the two sides called balance shall reflect the amount due to the customer. In a T account, the left side is called debit, often abbreviated as Dr., and the right side is known as credit, often abbreviated as CR. 2. Rationalized 2023-2453. Recording of transactions. I. The summary of effects of transactions on accounting equation as in the following analysis table. Enter amount on the left side of an account is to debit the account. To enter amount on the right side is to credit the account. Account title. Left side, right side. Fig. 3.4, showing T account. 3.3.1 Rules of debit and credit. All accounts are divided into 5 categories for the purposes of recording the transactions. A. Asset. B. Liability. C. Capital. D. Expenses, losses, and A. Revenues, gains. 2 fundamental rules are followed to record the changes in these accounts. 1. For recording changes in assets, expenses, losses, I. Increase in asset is debited, and decrease in asset is credited. E. Increase in expenses, losses is debited, and decrease in expenses, losses is credited. 2. For recording changes in liabilities and capital, revenues, gains, I. Increase in liabilities is credited and decrease in liabilities is debited. E. Increase in capital is credited and decrease in capital is debited. E. Increase in revenue, gain is credited and decrease in revenue, gain is debited. The rules applicable to the different kinds of accounts have been summarized in the following chart. Rules of debit and credit. Asset. Increase, decrease, plus debit credit. Capital. Decrease, increase, plus debit credit. Revenues, gains. Decrease, increase, plus debit credit. Liabilities. Decrease, increase, plus debit. Transactions in example 1 on page 46 will help you to learn how to apply these debit and credit rules. Observe the analysis table given on page 48 carefully to be sure that you understand before you go on to the next one. To illustrate different kinds of events, 3 more transactions have been added, transactions 7 to 9. 1. Rohit started business with cash back quote 500,000. Analysis of transaction. The transaction increases cash on one hand and increases capital on the other hand. Increases in assets are debited and increases in capital are credited. Therefore, record the transaction with debit to cash and credit to Rohit's capital. 2. Opened a bank account with an amount of back quote 480,000. Analysis of transaction. The transaction increases the cash at bank on one hand and decreases cash in hand on the other hand. Increases in assets are debited and the decreases in assets are credited. Therefore, record the transactions with debit to bank account and credit to cash account. 3. Bought furniture for back quote 60,000 and issued check for the same. Analysis of transaction. This transaction increases furniture, assets, on one hand and decreases bank, assets, on the other hand by back quote 60,000. Increases in assets are debited and decreases are credited. Therefore, record the transactions with debit to furniture account and credit to bank account. 4. Bought plant and machinery from Ramji Lal for the business for 125,000 and an advance of 10,000 in cash is given. Analysis of transaction. This transaction increases plant and machinery, assets, by 125,000, decreases cash by 10,000 and increases liabilities, M.S. Ramji Lal is creditor, by 115,000. Increases in assets are debited whereas decreases in assets are credited. On the other hand, increases in liabilities are credited. Therefore, record the transaction with debit to furniture account and with credit to cash and Ramji Lal's account. Cash account 1. 500,000. Capital account 1. 500,000. 6. 10,000. Cash account 1. 500,000 2. 4. 80,000. Bank account 2. 480,000. Furniture account 1. 60,000. Bank account 2. 480,000 3. 60,000. Rationalized 2023-24 56 Accountancy 5. Goods purchased from Sumit Traders for 55,000 Analysis of transaction. This transaction increases purchases, expenses, and increases liabilities, M.S. Sumit Traders as creditors, by 55,000. Increases in expenses are debited and increases in liabilities are credited. Therefore, record the transaction with debit to purchases account and credit to Sumit Traders account. 6. Understanding. I. 1. Double entry accounting requires that I. All transactions that create debits to asset accounts must create credits to liability or capital accounts. E. A transaction that requires a debit to a liability account require a credit to an asset account. E. Every transaction must be recorded with equal debits equal total credits. 2. State different kinds of transactions that increase and decrease capital. 3. Does debit always mean increase and credit always mean decrease? 4. Which of the following answers properly classifies these commonly used accounts? 1. Building. 2. Wages. 3. Credit sales. 4. Credit purchases. 5. Electricity charges due but not yet paid. Outstanding electricity bills. 6. 3.4 Books of original entry. In the preceding pages, you learnt about debits and credits and observed how transactions affect accounts. This process of analyzing transactions and recording their effects directly in the accounts is helpful as a learning exercise. However, real accounting systems do not record transactions directly in the accounts. The book in which the transaction is recorded for the first time is called Journal or Book of Original Entry. The source document, as discussed earlier, is required to record the transaction in the journal. This practice provides a complete record of each transaction in one place and links the debits and credits for each transaction. After the debits and credits for each transaction are entered in the journal, they are transferred to the individual accounts. The process of recording transactions in journal is called journalizing. Once the journalizing process is completed, the journal entry provides Rationalized 2023-24 Recording of Transactions, I-61. A complete and useful description of the events effect on the organization. The process of transferring journal entry to individual accounts is called posting. This sequence causes the journal to be called the Book of Original Entry and the ledger account as the principal book of entry. In this context, it should be noted that on account of the number and commonality of most transactions, the journal is subdivided into a number of books of original entry as follows: A. Journal proper. B. Cash book. C. Other day books. I. Purchases, journal, book. E. Sales, journal, book. E. Purchase returns, journal, book. IV. Sale returns, journal, book. V. Bills receivable, journal, book, V. Bills payable, journal, book. In this chapter you will learn about the process of journalizing and their posting into ledger. The cash book and other day books are dealt in detail in chapter 4. 3.4.1 Journal. This is the basic book of original entry. In this book, transactions are recorded in the chronological order, as and when they take place. Afterwards, transactions from this book are posted to the respective accounts. Each transaction is separately recorded after determining the particular account to be debited or credited. The format of journal is shown as figure 3.5. Journal. Date particulars LF debit credit. Amount. Fig. 3.5. Showing the format of journal. The first column in a journal is date on which the transaction took place. In the particulars column, the account title to be debited is written on the first line beginning from the left-hand corner, and the word Doctor is written at the end of the column. The account title to be credited is written on the second line, leaving sufficient margin on the left side with a prefix, to. Below the account titles, A. Rationalized 2023-2462 Accountancy. Brief description of the transaction is given, which is called narration. Having written the narration, a line is drawn in the particulars column, which indicates the end of recording the specific journal entry. The column relating to ledger folio records the page number of the ledger book on which relevant account appears. This column is filled up at the time of posting and not at the time of making journal entry. The debit amount column records the amount against the account to be debited, and similarly the credit amount column records the amount against the account to be credited. It may be noted that the number of transactions is very large, and these are recorded in number of pages in the journal book. Hence, at the end of each page of the journal book, the amount columns are totaled and carried forward, C.F., to the next page where such amounts are recorded as brought forward, B.F., balances. The journal entry is the basic record of a business transaction. It may be simple or compound. When only two accounts are involved to record a transaction, it is called a simple journal entry. For example, goods purchased on credit for Rs. 30,000 from M.S. Govind Traders on December 24, 2017, involves only two accounts, A. Purchasers A. C. Goods, B. Govind Traders A. C. Creditors. This transaction is recorded in the journal as follows. Journal. Date particulars LF debit credit. Amount 2014. Dec. 24 Purchases A. C. Dr. 30,000 to Govind Traders A. C. 30,000 Purchase of goods in trade from Govind Traders. It will be noticed that although the transaction results in an increase in stock of goods, the account debited is purchases, not goods. In fact, the goods account is divided into 5 accounts, viz. Purchases account, sales account, purchases returns account, sales returns account, and stock account. When the number of accounts to be debited or credited is more than one, entry made for recording the transaction is called compound journal entry. That means compound journal entry involves multiple accounts. For example, office furniture is purchased from Modern Furnitures on July 4, 2017 for $25,000 and $5,000 is paid by cash immediately and balance of $20,000 is still payable. It increases furniture assets by $25,000, decreases cash assets by $5,000 and increases liability by $20,000. The entry made in the journal on July 4, 2017 is Rationalized 2023-24 Recording of Transactions, I-63. Journal. Date particulars LF debit credit. Amount 2017 Office Furniture A. C. Dr. 25,000 July 4 to cash A. C5,000 to Modern Furniture A, C20,000, purchase of office furniture from Modern Furnitures. Now refer to example 1 on page 46 again and observe how the transactions listed are recorded in the journal. Any IGST credit will first be applied to set off IGST and then CGST. Balance, if any, will be applied to set off SGST. 3.5 The ledger. The ledger is the principal book of accounting system. It contains different accounts where transactions relating to that account are recorded. A ledger is the collection of all the accounts, debited or credited, in the journal proper and various special journal, about which you will learn in chapter 4. A ledger may be in the form of bound register, or cards, or separate sheets may be maintained in a loose leaf binder. In the ledger, each account is opened preferably on separate page or card. Utility. A ledger is very useful and is of utmost importance in the organization. The net result of all transactions in respect of a particular account on a given date can be ascertained only from the ledger. For example, the management on a particular date wants to know the amount due from a certain customer or the amount the firm has to pay to a particular supplier. Such information can be found only in the ledger. Such information is very difficult to ascertain from the journal because the transactions are recorded in the chronological order and defies classification. For easy posting and location, accounts are opened in the ledger in some definite order. For example, they may be opened in the same order as they appear in the profit and loss account and in balance sheet. In the beginning, an index is also provided. For easy identification, in big organizations, each account is also allotted a code number. Format of the account is shown in figure 3.6. Rationalized 2023-24 recording of transactions, I-73. Name of the account. Drive CR. Date particulars JF amount. Date particulars JF amount. Fig. 3.6, showing format of a ledger. According to this format, the columns will contain the information as given below. An account is debited or credited according to the rules of debit and credit already explained in respect of each category of account. Title of the account. The name of the item is written at the top of the format as the title of the account. The title of the account ends with suffix account. Doctor, CR. Doctor means debit side of the account, that is left side, and CR means credit side of the account, i.e. right side. Date, year, month and date of transactions are posted in chronological order in this column. Particulars. Name of the item with reference to the original book of entry is written on debit, credit side of the account. Journal folio. It records the page number of the original book of entry on which relevant transaction is recorded. This column is filled up at the time of posting. Amount. This column records the amount in numerical figure, corresponding to what has been entered in the amount column of the original book of entry. Test your understanding. 3. Choose the correct answer. 1. The ledger folio column of journal is used to a. Record the date on which amount posted to a ledger account. B. Record the number of ledger account to which information is posted. C. Record the number of amounts posted to the ledger account. D. Record the page number of the ledger account. 2. The journal entry to record the sale of services on credit should include a. Debit to debtors and credit to capital. B. Debit to cash and credit to debtors. C. Debit to fees income and credit to debtors. D. Debit to debtors and credit to fees income. 3. The journal entry to record purchase of equipment for $200,000 cash and a balance of $800,000 due in 30 days include a. Debit equipment for $200,000 and credit cash $200,000. Rationalized 2023-24-74 Accountancy. B. Debit equipment for backquote 1 million and credit cash backquote 200,000 and creditors backquote 800,000. C. Debit equipment backquote 200,000 and credit debtors backquote 800,000. D. Debit equipment backquote 1 million and credit cash backquote 1 million. 4. When an entry is made in journal, A. Assets are listed first. B. Accounts to be debited listed first. C. Accounts to be credited listed first. D. Accounts may be listed in any order. 5. If a transaction is properly analyzed and recorded, only two accounts will be used to record the transaction. B. One account will be used to record transaction. C. One account balance will increase and another will decrease. D. Total amount debited will equals total amount credited. 6. The journal entry to record payment of monthly bill will include A. Debit monthly bill and credit capital. B. Debit capital and credit cash. C. Debit monthly bill and credit cash. D. Debit monthly bill and credit creditors. 7. Journal entry to record salaries will include A. Debit salaries credit cash. B. Debit capital credit cash. C. Debit cash credit salary. D. Debit salary credit creditors. Distinction between journal and ledger. The journal and the ledger are the most important books of the double entry mechanism of accounting and are indispensable for an accounting system. Following points of comparison are worth noting. 1. The journal is the book of first entry, original entry. The ledger is the book of second entry. 2. The journal is the book for chronological record. The ledger is the book for analytical record. 3. The journal, as a book of source entry, gets greater importance as legal evidence than the ledger. 4. Transaction is the basis of classification of data within the journal. Account is the basis of classification of data within the ledger. 5. Process of recording in the journal is called journalizing. The process of recording in the ledger is known as posting. Rationalized 2023-24 Recording of Transactions, I-75. 3.5.1 Classification of ledger accounts. We have seen earlier that all ledger accounts are put into 5 categories, namely, assets, liabilities, capital, revenues, gains and expense losses. All these accounts may further be put into 2 groups, i.e. permanent accounts and temporary accounts. All permanent accounts are balanced and carried forward to the next accounting period. The temporary accounts are closed at the end of the accounting period by transferring them to the trading and profit and loss account. All permanent accounts appears in the balance sheet. Thus, all assets, liabilities and capital accounts are permanent accounts and all revenue and expense accounts are temporary accounts. This classification is also relevant for preparing the financial statements. 3.6 Posting from journal. Posting is the process of transferring the entries from the books of original entry, journal, to the ledger. In other words, posting means grouping of all the transactions in respect to a particular account at one place for meaningful conclusion and to further the accounting process. Posting from the journal is done periodically, maybe weekly or fortnightly or monthly as per the requirements and convenience of the business. The complete process of posting from journal to ledger has been discussed below. Step 1. Locate in the ledger the account to be debited as entered in the journal. Step 2. Enter the date of transaction in the date column on the debit side. Step 3. In the particulars column, write the name of the account through which it has been debited in the journal. For example, furniture sold for cash backquote 34,000. Now, in cash account on the debit side in the particulars column, furniture will be entered, signifying that cash is received from the sale of furniture. In furniture account, in the ledger on the credit side is the particulars column, the word cash will be recorded. The same procedure is followed in respect of all the entries recorded in the journal. Step 4. Enter the page number of the journal in the folio column, and in the journal write the page number of the ledger on which a particular account appears. Step 5. Enter the relevant amount in the amount column on the debit side. It may be noted that the same procedure is followed for making the entry on the credit side of that account to be credited. An account is opened only once in the ledger, and all entries relating to a particular account is posted on the debit or credit side, as the case may be. We will now see how the transactions listed in example on page 46 to 47 are posted to different accounts from the journal. Rationalized 2023-24-76 Accountancy. Cash account. As to your understanding, IV. Fill in the blanks. 1. Issued a check for backquote 8,000 to pay rent. The account to be debited is 2. Collected backquote 35,000 from debtors. The account to be credited is 3. Purchased office stationery for backquote 18,000. The account to be credited is 4. Purchased new machine for backquote 170,000 and issued check for the same. The account to be debited is 5. Issued check for backquote 70,000 to pay off one of the creditors. The account to be debited is 6. Returned damaged office stationery and received backquote 50,000. The account to be credited is 7. Provided services for backquote 65,000 on credit. The account to be debited is Rationalized 2023-24-78 Accountancy. Illustration 4. As to your understanding, we select right answer. 1. Voucher is prepared for I. Cash received and paid, E. Cash, credit sales, E. Cash, credit purchase, IV. All of the above. 2. Voucher is prepared from I. Documentary evidence, E. Journal entry, E. Ledger account, IV. All of the above. 3. How many sides does an account have? I. 2, E. 3, E. 1, IV. None of these 4. A purchase of machine for cash should be debited to I. Cash account, E. Machine account, E. Purchase account, IV. None of these 5. Which of the following is correct? I. Liabilities equals assets plus capital, E. Assets equals liabilities, capital, E. Capital equals assets, liabilities, IV. Capital equals assets plus liabilities. 6. Cash withdrawn by the proprietor should be credited to I. Drawings account, E. Capital account, E. Profit and loss account, IV. Cash account. 7. Find the correct statement. I. Credit a decrease in assets, E. Credit the increase in expenses, E. Debit the increase in revenue, IV. Credit the increase in capital. 8. The book in which all accounts are maintained is known as I. Cash book, E. Journal, E. Purchaser's book, IV. Ledger. 9. Recording of transaction in the journal is called I. Casting, E. Posting, E. Journalizing, IV. Recording. Rationalized 2023-24 Recording of Transactions, I-87. Key terms introduced in the chapter. Source documents, credit, accounting equation, debit, books of original entry, account, journalizing and posting, ledger, double entry bookkeeping, journal. Summary with reference to learning objectives. 1. Meaning of source documents. Various business documents such as invoice, bills, cash memos, vouchers, which form the basis and evidence of a business transaction recorded in the books of account, are called source documents. 2. Meaning of accounting equation. A statement of equality between debits and credits signifying that the assets of a business are always equal to the total liabilities and capital. 3. Rules of debit and credit. An account is divided into two sides. The left side of an account is known as debit and the credit. The rules of debit and credit depend on the nature of an account. Debit and credit both represent either increase or decrease, depending on the nature of an account. These rules are summarized as follows: name of an account: debit, credit, assets increase, decrease, liabilities decrease, increase, capital decrease, increase, revenues decrease, increase, expenses increase, decrease. 4. Books of original entry. The transactions are first recorded in these books in a chronological order. Journal is one of the books of original entry. The process of recording entries in the journal is called journalizing. 5. Ledger. A book containing all accounts to which entries are transferred from the books of original entry. Posting is process of transferring entries from books of original entry to the ledger. Questions for practice. Short answers. 1. State the 3 fundamental steps in the accounting process. 2. Why is the evidence provided by source documents important to accounting? 3. Should a transaction be first recorded in a journal or ledger? Why? 4. Are debits or credits listed first in journal entries? Are debits or credits indented? 5. Why are some accounting systems called double accounting systems? 6. Give a specimen of an account. Rationalized 2023-24-88 Accountancy. 7. Why are the rules of debit and credit same for both liability and capital? 8. What is the purpose of posting J.F. numbers that are entered in the journal at the time entries are posted to the accounts? 9. What entry, debit or credit, would you make to a. Increase revenue, b. Decrease in expense, c. Record drawings, d. Record the fresh capital introduced by the owner? 10. If a transaction has the effect of decreasing an asset, is the decrease recorded as a debit or as a credit? If the transaction has the effect of decreasing a liability, is the decrease recorded as a debit or as a credit? Long answer.